So as you watch the market right now, instead of focusing only on what is falling, ask a different question. What is quietly building strength beneath the surface? What is being ignored? What is being undervalued? These questions shift your perspective from reaction to observation, and that shift alone can change how you see opportunity, because the market often hides its biggest moves in plain sight, but only for those who are looking in the right direction. In the end, the difference between those who grow wealth and those who miss it is not access or luck. It is awareness and action, the ability to understand what is happening beneath the surface and the willingness to act before it becomes obvious. Because when the shift finally becomes clear to everyone, the real move is already over, and the only thing left is the story of how it happened. Logistics. And there is one location that matters more than anything else right now: the Strait of Hormuz. This is a narrow strip of water, barely 20 miles wide, but nearly 20% of the world's oil supply flows through it every single day. And here's the key insight. It does not need to be shut down to create chaos. It just needs to become risky enough that shipping companies hesitate and insurance companies panic. Because once insurance premiums spike or coverage disappears, tankers stop moving. And when tankers stop moving, supply drops, not because oil disappeared, but because it cannot reach buyers. And markets do not wait for confirmation. They price in risk instantly. So the moment this route becomes unstable, oil prices begin to climb. And once oil moves, everything else starts moving with it. Because oil is not just fuel, it is embedded in the entire global economy. Every truck, every ship, every airplane, every factory, every supply chain, every piece of food production, every fertilizer, every plastic, every pharmaceutical, all of it depends on energy. So when oil rises, costs rise everywhere, not gradually, but structurally and immediately. And this is where the second layer of the chain reaction begins: inflation. Because higher energy costs push up the price of goods, transportation, and production across the board. And once inflation rises, central banks like the Federal Reserve are forced into a corner because they cannot cut interest rates in an inflationary environment. And this is where most investors get caught off guard. Because the entire market narrative was built on the expectation of rate cuts, lower rates, cheaper money, higher stocks. But now that narrative is breaking, because if oil keeps pushing inflation higher, central banks are forced to hold rates higher for longer, or even raise them. And that changes everything, because higher rates mean borrowing becomes more expensive, companies take on less debt, expansion slows down, profits get squeezed, and stock valuations come under pressure, especially in sectors that rely heavily on cheap capital, like tech, infrastructure, and large-scale growth projects. And this is where the third layer kicks in: currency strength. Because higher interest rates attract capital into the dollar, strengthening it. And a stronger dollar creates pressure on commodities, including gold. Because gold is priced in dollars, so when the dollar rises, gold becomes more expensive for global buyers, reducing demand and pushing prices lower. And now you start to see the full picture. Oil goes up, inflation rises, central banks stay hawkish, rates stay high, the dollar strengthens, and gold, instead of rising, begins to fall. And then comes the fourth and most aggressive layer: leverage. Because modern markets are filled with leveraged products, especially in gold ETFs, where investors use 2x or 3x exposure to amplify returns. And this works on the way up, but on the way down, it becomes destructive. Because a small drop in gold prices turns into a much larger loss for leveraged investors, triggering margin calls, forcing them to sell, and that forced selling pushes prices even lower, creating a cascading effect where selling leads to more selling. And this is how you get a sharp and unexpected drop in an asset that was supposed to be a safe haven. And while retail investors panic and sell, institutions often do the opposite. They wait for these moments of forced liquidation to accumulate positions at better prices. And this is one of the biggest differences between smart money and retail behavior. Smart money reacts to structure, retail reacts to headlines. Now let's take this one step deeper, because understanding the chain reaction is not enough. You need to understand the phases of market behavior, because markets move in cycles, and right now, we are transitioning from the panic phase into the repositioning phase. The panic phase is where everything sells, volatility spikes, and fear dominates headlines. The repositioning phase is where capital starts flowing into sectors that benefit from the new environment. And in a world of rising energy costs and persistent inflation, certain sectors begin to outperform. Energy companies obviously benefit from higher oil prices, but more specifically, infrastructure players, pipeline operators and service providers often capture consistent revenue regardless of price volatility because they operate like toll collectors in the system. Defense sectors may see increased demand due to geopolitical tensions, but a lot of that is often priced in already, so selectivity matters. Companies with strong pricing power, meaning they can pass on higher costs to consumers, also tend to perform better in inflationary environments. While sectors like airlines, which rely heavily on fuel costs and operate on thin margins, struggle significantly because rising oil prices directly hit their profitability. At the same time, consumer discretionary spending weakens because higher costs reduce disposable income. And interest rate-sensitive sectors like banking and real estate can face pressure due to tighter financial conditions, and this creates a very specific environment where not everything moves together anymore. The era of easy gains across all assets fades, and capital becomes more selective. And this is where most investors struggle, because they are used to broad market rallies driven by cheap money. But in this environment, strategy matters, positioning matters, and understanding macro flows matters more than ever. Now, let's come back to gold, because this is where confusion is highest. Gold is not broken, it is reacting to a different set of forces than people expect. In the short term, gold can fall in a rising rate and strong dollar environment, even during geopolitical stress, because liquidity and currency strength dominate in the immediate reaction. But over the longer term, if inflation persists and real rates stabilize, gold can regain strength, which means timing and positioning matter far more than blind belief in narratives. And this is where patience becomes a competitive advantage, because the market is designed to shake out weak hands before the real move happens. And if you understand the chain reaction, you don't need to predict headlines, you simply follow the flow of money and position accordingly. And that is the difference between reacting and anticipating, because by the time news becomes obvious, the opportunity is usually already gone. So the real question is not what will happen next. The real question is, are you positioned for the environment we are already in? Because this shift is not temporary, it is structural, and those who understand it early will have a massive... Now here's where things start getting really interesting, because once you understand the chain reaction, you stop looking at markets as random movements and start seeing them as a system of money flows and incentives. And right now, that system is shifting in real time, and most people are completely missing it because they are focused on headlines instead of structure. So let's go deeper into what actually happens after the initial shock phase, because this is where real opportunities begin to form, and also where the biggest mistakes are made. Because after panic selling slows down, capital does not just disappear, it relocates, and it always flows toward areas that benefit from the new environment. And in a high energy cost world, money starts rotating into sectors that either directly profit from rising prices or have the power to pass costs onto consumers without losing demand. And this is where pricing power becomes one of the most important concepts you need to understand, because companies with strong pricing power can maintain margins even when costs rise, while companies without it get squeezed and lose profitability. And this is why you often see a divergence in stock performance during inflationary periods, because not all businesses are equal. Some can adapt and some cannot. And identifying that difference is where the edge comes from. Now think about this from a simple perspective. If oil prices double, what happens to a business that relies heavily on transportation but cannot raise prices easily? Its costs go up, its margins shrink, and its earnings decline. But what about a business that can increase its prices without losing customers? Its revenue rises along with costs, and in some cases, margins even expand. And this is why during inflation, certain sectors outperform while others struggle. And understanding this allows you to position ahead of the crowd instead of reacting after the fact. Now let's talk about something even more important, liquidity. Because liquidity is the lifeblood of financial markets, and it determines how assets move in the short term, more than fundamentals do. And liquidity is heavily influenced by central bank policy, interest rates, and global capital flows. And right now, liquidity is tightening because higher rates reduce the availability of cheap money. And this creates a very different environment compared to the previous years, where liquidity was abundant and easy to access. And when liquidity tightens, volatility increases, because there is less capital available to absorb shocks. And this is why markets become more sensitive to news and more reactive to changes in sentiment. And this is also why you see sharper moves, both up and down, because smaller flows can have a larger impact on prices. And this creates opportunities, but also increases risk, because timing becomes more important and mistakes become more costly. And now, let's connect this back to gold, because gold is highly sensitive to liquidity and real interest rates. And this is where most people get confused, because they think of gold purely as a safe haven. But in reality, gold is also a liquidity asset. And when liquidity tightens and real rates rise, gold can struggle, even in uncertain environments, because investors need cash. They need dollars, and they need to meet obligations, and this forces them to sell assets, including gold. And this is why you often see gold decline during the initial stages of a crisis, before it eventually recovers once central banks respond and liquidity conditions improve. And this pattern has repeated multiple times in history, and it is playing out again right now. And if you do not understand this dynamic, you will constantly be surprised by market behavior and make decisions based on incomplete information. Now let's shift focus to the behavior of institutions, because this is where the real game is played. Institutional investors do not think in terms of headlines. They think in terms of positioning, risk management, and probability. And one of the key strategies they use is accumulation during weakness and distribution during strength, which means they are often buying when retail is selling and selling when retail is buying. And this is not because they are smarter in a general sense, but because they have access to better data, better tools, and more disciplined processes. And one of the most important signals they track is flow data, where money is actually moving, not where people say it is moving. And this includes tracking ETF flows, futures, positioning, options activity, and cross-asset correlations. And while retail investors are looking at price charts, institutions are looking at positioning. And when they see forced selling, they often step in because they know that those moves are not driven by fundamentals, but by liquidity constraints. And this creates opportunities to enter positions at favorable prices. And this is why understanding market structure gives you an advantage, because you can start thinking like a participant instead of a spectator. And now, let's take this one step further and talk about second-order effects. Because the first-order effect of rising oil is higher inflation, but the second-order effects are where things become more complex and more interesting. Because higher inflation leads to changes in consumer behavior, business investment, and government policy. And these changes create ripple effects across the economy. For example, when energy costs rise, consumers spend more on essentials and less on discretionary items, which impacts sectors like retail, travel, and entertainment. At the same time, businesses may delay expansion, reduce hiring, or cut costs to maintain profitability. And governments may introduce policies to control inflation or support growth. And each of these actions creates new dynamics that influence markets, and understanding these second-order effects allows you to anticipate changes before they become obvious. And this is where real insight comes from, not from predicting events, but from understanding how systems respond to those events. And now, let's bring this back to your positioning, because at the end of the day, all of this information is only useful if it helps you make better decisions. And the key here is not to overreact, but to adapt gradually based on evidence and structure, because markets reward discipline and punish impulsive behavior. And one of the biggest mistakes investors make is chasing trends after they become obvious and abandoning positions during temporary volatility. And this is exactly what creates opportunities for those who remain patient and focused on the bigger picture. And this is also why risk management is critical, because no matter how strong your analysis is, markets can behave unpredictably in the short term, and protecting your downside allows you to stay in the game long enough to benefit from your insights. And this includes managing position sizes, diversifying exposure, and avoiding excessive leverage, because leverage amplifies both gains and losses, and in volatile environments, it can quickly turn a manageable situation into a major loss. And this is something that many investors learn the hard way, especially during periods of rapid market movement. And now, let's talk about one of the most overlooked aspects of investing psychology, because psychology plays a massive role in decision-making, and understanding it can help you avoid common pitfalls. Fear and greed are the two dominant emotions in markets, and they often lead to poor decisions, buying at peaks and selling at bottoms. And this is not because people lack intelligence, but because emotional responses override rational thinking under pressure. And this is why having a framework is so important, because it allows you to make decisions based on logic rather than emotion. And this is also why experienced investors focus on process rather than outcomes, because outcomes can be influenced by randomness in the short term, but a solid process leads to better results over time. And this is the mindset shift that separates consistent performers from those who struggle. And now, let's zoom out and look at the bigger picture, because what we are seeing right now is not just a short-term fluctuation, but part of a larger transition in the global economy, from a period of low inflation and abundant liquidity to a period of higher volatility, tighter conditions, and more selective opportunities. And this transition creates both challenges and opportunities depending on how you approach it. And those who adapt will find ways to benefit, while those who rely on outdated assumptions will struggle. And this is why continuous learning and flexibility are essential, because markets evolve and strategies that worked in one environment may not work in another. And being able to recognize these shifts early gives you a significant advantage. And in the next part, we are going to go even deeper into specific strategies, sector analysis, and how to build a resilient approach that can navigate this changing environment without relying on guesswork or hype. And this is where everything comes together into a practical framework you can actually use.